You got the promotion, the salary you always wanted. Maybe you even crossed that psychological milestone, 50 grand a year. And yet, it doesn't feel like it. You're not driving a nicer car. You're not booking an extra holiday. Your savings aren't jumping the way you expected. You sit down, look at your bank balance, and genuinely can't work out where it's all going. On paper, you earn £50,000. In reality, it feels closer to £30,000 once the system has taken its cut. This video is the answer. Because what's happening to you isn't bad luck, it isn't lifestyle inflation, and it isn't a budgeting mistake. It's a deliberate, engineered system that successive governments have leaned on to quietly extract billions from working people, without ever having to say the words, "We raised your taxes." Let's start with the foundations, because most people don't actually understand how UK income tax works. And that's partly by design. Your salary isn't taxed as one lump sum. It's taxed in slices called bands. Right now, in the 2025/26 tax year, those bands look like this. The first £12,570, completely tax-free. That's called your personal allowance. From £12,571 to £50,270, you pay 20%. That's the basic rate band. From £50,271 upwards, you pay 40%. That's the higher rate. So on a £50,000 salary, here's the actual maths. £12,570 is tax-free. The next £37,430 gets taxed at 20%. That's £7,486. Nothing hits the 40% band, yet. Then on top of that, you pay employee national insurance at 8% on earnings between roughly £12,570 and £50,270. That adds another £3,000 or so. So before you've even left the house, roughly £10,500 has been taken from that £50,000. That brings your take-home to somewhere around £39,500. And we haven't talked about council tax, pension contributions, energy bills, or anything else yet. But here's the key question, and this is what the rest of this video is about. Why does this feel so much worse than it did 5 years ago, even though the rates haven't changed? Here is where the story gets interesting. In the spring of 2021, then-Chancellor Rishi Sunak announced something that most people completely ignored. He said that the personal allowance, that £12,570 figure, and the higher rate threshold at £50,270 would be frozen. Not cut, not raised, just left exactly where they were. Originally, this was meant to last until 2026. Then Jeremy Hunt extended it to 2028. Then Rachel Reeves extended it again to 2031. 10 full years of frozen thresholds. The policy is now encoded in the Finance Act 2026. So why does this matter? Because over those same 10 years, wages have gone up. Prices have gone up. Inflation has eaten into everything. And the Office for National Statistics confirmed that cumulative CPI inflation across the freeze period is heading toward 25%. Now, ask yourself this. If your salary grows with inflation, but the band at which you start paying tax doesn't move, what happens? More and more of your income gets pulled into the taxable zone. You don't feel richer, you just pay more. That's fiscal drag. The threshold stays still. Your wages, however modestly, inch upward. And silently, without anyone ever voting on a tax rise, your effective tax rate goes up every single year. The Institute for Chartered Accountants in England and Wales has calculated that if the personal allowance had been adjusted for inflation, it would be worth £15,480 for 2025 to 26, nearly £3,000 more than it currently is. Every basic rate taxpayer earning over that amount is paying at least £582 more per year, purely because of the freeze. By 2030/31, the OBR estimates the higher rate threshold should be approaching £70,000 if it had tracked inflation. Instead, it's still sitting at £50,270. Here's something nobody talks about enough. In 2019 to 20, there were 3.83 million higher rate taxpayers in the UK, people paying 40% on part of their income. By 2023 to 24, that number had jumped to 5.76 million. That is a 50% increase in the number of people paying the higher rate, not because 500,000 people suddenly got rich, but because the threshold didn't move while wages did. Think about what that actually means. A nurse who got a cost of living pay rise. A teacher who was finally given a meaningful increment. A project manager who negotiated a modest increase after 3 years stuck at the same salary. Millions of people who do not consider themselves high earners, people who are objectively in the middle of the country's income distribution, are now technically paying the higher rate. And here's the thing nobody says out loud. 40% on a £52,000 salary isn't the same as 40% on a £200,000 salary. The practical experience is completely different, but the tax code treats them identically. By 2031, the Resolution Foundation estimates that 4.4 million additional taxpayers will have been pushed into the higher rate band versus what would have happened if thresholds had been indexed to inflation. This isn't a side effect. This is the plan. The OBR estimates that freezing thresholds will raise the government over £55 billion in 2030/31 alone. Now let's zoom in on the specific experience of someone earning around £50,000, because this is where something truly bizarre happens. You cross £50,270 and suddenly you're a higher rate taxpayer. On paper, that sounds like you've arrived somewhere. In practice, it means every extra pound you earn above that line is taxed at 40%, plus 2% employee NI. That's an effective marginal rate of 42% on every additional pound. But here's the trap nobody explains clearly. Your gross salary of £50,000 puts you right at the edge. One small pay rise, £1,000, say, and you start paying 42 pence in every pound on that increment. That means the effective return on a £1,000 pay rise above £50,270 is just £580. If your employer gives you a £2,000 raise, you keep roughly £1,160 of it. And remember, your employer already paid employer national insurance on that £2,000 at 15% following the April 2025 increase. So the full cost to your employer was £2,300 and you received £1,160. The government took £1,140, or approximately 50% of the total cost of giving you that raise. This is not a conspiracy theory. This is HMRC policy. Here's a point that almost no financial content makes, and it genuinely changes how you should think about your salary. When your employer says you earn £50,000, that is not what you cost them. On top of your salary, they pay employer national insurance. From April 2025, that rate increased from 13.8% to 15%, and the threshold at which it kicks in was simultaneously reduced from £9,100 to £5,000 per employee. This was a double hit. On a £50,000 salary, your employer now pays approximately £6,750 in employer NI on top of your wages. Money that legally belongs to the government, not to you, and which you never see. So the true cost of employing you is roughly £56,750. You receive £50,000, and then you lose another £10,500 in income tax and employee NI on top of that. The government's total take on your £50,000 salary, combining your income tax, your employee NI, and your employer's NI, is somewhere around £17,000 to £18,000. Out of a total employment cost of approximately £56,750, you keep around £39,500. Economists at Lockton noted specifically that the employer NI changes are expected to suppress wage growth, because when employers' costs go up, they have less room to offer pay rises. So this tax doesn't just hit employers. Over time, it caps what you're likely to earn in the future. Now let's add a cost that's entirely separate from income tax, but is quietly eating a bigger share of your income every year. Council tax. The average Band D council tax bill in England for 2025/26 is £2,280, up 5% from the year before, and up again for 2026/27 to approximately £2,392. Here's the thing about council tax that's never discussed. It is completely disconnected from your income. A household earning £30,000 pays essentially the same bill as a household earning £80,000 in the same property band, in the same area. That means council tax acts as a regressive burden. It hits lower and middle earners proportionally far harder than higher earners. And council tax has risen relentlessly. In the 3 years to 2025/26, it went up by roughly 5% annually, each year, in most of England. Meanwhile, the personal allowance hasn't moved. There is no indexation. There is no fiscal drag conversation around council tax. Nobody talks about it. Yet for a household on a combined income of £80,000, that's over £2,300 coming out after tax. Money that in real terms is growing as a proportion of take-home pay every single year. Now let's go slightly up the income scale, because this one deserves its own mention, even if you're not there yet. Because understanding it explains the underlying philosophy of the system. If your income crosses £100,000, something extraordinary happens. Your personal allowance, that £12,570 of tax-free income you assumed was guaranteed, starts disappearing. For every £2 you earn above £100,000, you lose £1 of your allowance. By the time you hit £125,140, your personal allowance is gone entirely. In that band, £100,000 to £125,140, your effective marginal tax rate is not 40%. It is 60%. Here's why. You're paying 40% income tax. But every extra pound also causes you to lose 50 pence of personal allowance. And that 50 pence gets taxed at 40%, adding another 20 pence. Add 2% employee NI, and you're in a 62% marginal rate zone. The critical thing to understand is that this £100,000 threshold has been frozen since 2010. It's never been indexed to inflation. What was once a genuinely high income, barely 1 in 20 workers earned that in 2010. Now increasingly captures people who've had 15 years of normal pay progression. And there's a particularly cruel secondary trap. Crossing £100,000 means losing access to 30 hours of free childcare, worth approximately £6,000 per child per year, and losing tax-free childcare, worth up to £2,000 per child. A parent with 2 small children can face an effective marginal rate well above 100% on a specific slice of earnings, meaning earning an extra pound can, in certain scenarios, actually leave you worse off. This is not a thought experiment. It happens to tens of thousands of families every year. So now you know the system. Let's talk about how to legally reduce your exposure, because this is the part the government doesn't publicize. Pension contributions are your single most powerful tool. Every pound you contribute to a pension reduces your adjusted net income, the figure HMRC actually uses to assess your tax position. This means, if you earn £55,000 and contribute £5,000 to your pension, HMRC treats you as a basic rate taxpayer. You get 40% tax relief on that contribution and drop back below the higher rate threshold. If you earn £102,000, a £2,000 pension contribution can restore some or all of your personal allowance, saving you potentially thousands at the 60% effective rate. Salary sacrifice is how you do this most efficiently. By agreeing to a lower gross salary in exchange for employer pension contributions, you avoid both income tax and NI on that portion of pay. Your employer also saves on employer NI, which since April 2025 is 15%. There's an important caveat. At Budget 2025, the Chancellor announced that from 2029, salary sacrifice pension contributions above £2,000 per year will lose their NI exemption. The window is narrowing, but it's still open, and making use of it now is one of the most straightforward legal tax reductions available to a £50,000 earner. ISAs are your second tool. You can put up to £20,000 per year into a stocks and shares ISA. Growth inside an ISA is entirely free from tax. No capital gains, no income tax on dividends. Over a decade, the difference between sheltered and unsheltered investment growth is significant. If you're a couple where one partner earns less than £12,570, consider the marriage allowance, which transfers £1,260 of unused personal allowance and saves up to £252 per year. These aren't clever schemes. They're published HMRC policy. But most people never use them. Let's tie all of this together. You earn £50,000. Before you spend a single pound, the government takes roughly £10,500 in income tax and employee NI. Your employer paid another £6,750 to employ you that you never see. Your council tax bill is running at over £2,000 a year after tax. Inflation over the past 4 years has eroded the purchasing power of every pound you do take home. And none of this required a single vote. Not one politician had to stand up and say, "We're raising your taxes." Instead, they just didn't move a number. They froze a threshold. They held a line still and let the world move past it. That's fiscal drag. That's why £50,000 feels like £30,000. Not because you're imagining it, not because you're being irresponsible, but because between 2021 and 2031, the UK government ran a decade-long silent tax rise and chose to call it a freeze. The question now is, do you know it's happening, and are you doing anything about it? If you found this useful, subscribe, because there's a lot more of this that needs to be said.